Yo, what's up guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to take a look at the Nokia stock. I think we've got a lot of opportunity here, not only in the short term, but also the long term. So I wanted to break down the fundamentals, give you my thoughts, as well as my Nokia stock price prediction for the end of 2021. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me, hit the little bell so you get notified every time I post, and also like the video if you get any value out of it. It helps me a ton. I would really appreciate it. There's also a link down in the top pinned comment to my Patreon account. Come over and join the family. We've got an awesome community over there. We've also got a limited amount of spots down on the $10 tier. So if you want to jump on that, you'll get access to the private Discord where we talk stocks. You'll get all of my portfolios so you can see exactly what I invest into. And then anytime I buy or sell a stock up to the second I do it, I send it out so you can follow along. I also send out a lot of swing trade setups, which is absolutely the most valuable aspect. It's very educational. It helps you learn to identify and know what to look for. There's also education over there that you can use to become a much more profitable and efficient investor. So if that's something you're interested in, come over and join us. I think you'll get an immense amount of value out of it. Day one squad, I love you guys so much. Thank you for your support. But guys, let's get started. Real quick, we are doing the Patreon only night. Remember, go back to the Patreon, vote on the poll, guys, so that we can know what days we want to schedule it. I am really looking forward to it. It's going to be a lot of fun. We can do the live streams, analyze stocks, hang out, just kind of talk about the market. So, but guys, today I want to go over Nokia. This is a stock that is, very old, ancient. I'm sure a lot of you guys, if you're my age, had the Nokia brick phones back in high school that didn't have any color, and then they came out with color, and then they had like the beeping ringtones. You know what I'm talking about. Younger people, you probably have no idea, but they were big brick phones like that. But anyways, so this is a dinosaur stock, guys. Not very exciting until January when Wall Street Bets, the Apes got a hold of it. They short squeezed it way up, and then honestly, kind of sad, they threw it to the curb and it fell all the way back to $4 and kind of stayed there for a little while. But it is now recovered and has been in a consistent uptrend for a couple of months now. It's looking really good, guys. I kind of just glanced over the fundamentals, not with much expectation, and actually came out really impressed from what I did look at. So I wanted to break it down with you, see where it's at, what the value is, see if we can find something here that could potentially give us some really nice returns over the next couple of years and even in the next couple of months. So what we'll do is we'll go over the income statement. We'll take a look at the cash flow. We'll do the discounted free cash flow. We'll find the intrinsic value. We'll look at the chart and we'll wrap it up. First thing I want to show you guys. So this is just kind of the overview here. So like we've talked about, guys, this is one of those videos. I have not done my full DD. I do know that they're rapidly expanding into 5G, which is really important. Going to be a huge industry, and I think that's going to help them really ramp up growth over the next couple of years. I also know that Ericsson, one of their main competitors, just kind of got cut off from mainland China, which was like 60% of their sales. So that opens up a huge, leeway for Nokia to kind of capitalize. But on this video, guys, again, we are just going to look at the overview, look at it top down, surface level analysis to see if it's something we want to spend much more time doing a deep dive before we put our money in. So real quick, guys, you guys can see here today's volume, 1.66 million shares, excuse me. The average 3-month volume is 27.8 million shares, but the average 7-day volume is around 13.9 million. So really good volume, guys, very liquid stock, have no problem with that. Now, as far as the 52-week range, from $3.21 up to $9.79. So quite the jump there, guys. It like doubled twice and then went all the way back down. So, volatile stock at times. I don't think it's been very volatile lately, but it can be. So that's good for short-term trading. The outstanding shares at 5.65 billion. That is a lot of outstanding shares. Definitely not like some of these growth stocks we trade that have, 500 million shares. That's got a lot. So, it could take a lot more to move the needle, but at the same time, that there's companies out there with much more. So, market cap, guys, $34.1 billion. That is a massive market cap. So that's where we got to find out, okay, is it worth paying $34 billion for? I would say so, just from even top down because Nokia is a massive company, guys. And like I said, I think the 5G is really what's interesting me because of how much opportunity that has moving forward and how they're in a position to really capitalize on it. As you can see here, guys, the negative no PE ratio, right? So they've got negative net income, so they have no price to earnings, but the price to sales is 1.3, which is that's really good. That's exactly where you want to see it. This is really what got my attention, guys. Price to cash flow, 10.77. That's exactly in line with what you want to see. Now, I would even be willing to say that I could see it having a 15 and still being pretty fair value. Now, obviously, this isn't a high-flying growth stock that's doubling their cash flow every quarter, doubling their revenue, stuff like that. This is more of a very old, ancient, just stagnated company almost. So 10 is probably where it should be. You definitely wouldn't want to give it anything more than a 15, but I do think that you could get up there 13, 14. So it could be a little undervalued at these levels. I do think there's more upside based off of that. So now as far as gross profit margin, guys, 40.3, that is a really nice gross profit margin in their trailing 12 months. EBIT margin, 10.7, not too bad there. Net income margin is the one that's obviously lacking, negative 8.5. We would like to see that come up. Return on assets, about 4%, not bad. Return on equity, negative 13% almost, not that good. As far as revenue growth, negative 1.5%, guys. That's where I'm saying kind of getting that stagnation. We want to look at least 5 years back. So, not too concerned with seeing it like that in the trailing 12 months, but we'll have to see what it looks like from, 2015 on. All right, now as far as the income statement, let's take a look at that. So what we're looking for here, guys, is we're looking for revenue that's going to be growing or at least staying consistent over the last 5 years. Cost of revenue going down or staying the same, definitely not growing as fast as revenue, and gross profit staying the same or going up. As you guys can see here, a lot of data back from 2011. Look at how they did 20.7 billion back in 2011. But then that declined all the way until 2015, and in 2016 had a big jump to 24 billion. So, I don't know why that happened or what happened there. That's something you'd have to look into. But they went from 24.8 to 27.7, and then it started declining again. 25, is that a 5? Yeah, 25.8. Jumped again in 2018 to 26.1. 26.9 in 2020 and 26.3 in their trailing 12 months. So yes, it is going down if you look at it from 2017, but really that was a big up year and then pretty consistent from there. So the consistency is really what I like. Obviously we would like to see consistent revenue growth, right? But the fact that it is doing $26 billion a year is really impressive. The thing about it is, guys, if they were doing, 2 billion and they went from 2 billion to, 1.5 billion, that's a lot more concerning than going from 27 billion to 26.9 million. So not a huge concern there. Cost of revenue, same type of thing, guys, and that is staying really consistent. That's not really growing faster than the revenue. It's staying the same. Gross profit, same type of thing. We are getting a little bit of stagnation in the gross profit. I would like to see that go up a little bit more, and they did just release their full year 2021 guidance, and they did up that gross profit, by 2 percentage points on the top end, which is exactly what you want to see. Then they also increased their revenue guidance for full year 2021 as well by like $1 billion. So definitely what we want to see. Again, the reason why I like the fact that, they're staying consistent is because they've got so much opportunity moving forward with the 5G is where I really think you will start to see that revenue growth. Now, as far as the net income, guys, as you can see, losing a ton of money in the last trailing 12 months and 2020, 2.2 billion and 3 billion. I don't know why they were positive 7.9 million in 2018. That's something you'd have to look into. But what I will say is they were decreasing from like 2016. Then they had a big up year in 2017, and then they fell in 2018 and then went positive in 2019. So again, I don't know why that happened, but I would like to look into that because I would like to know how they went from negative almost 2 billion and then 2 years later positive. Something might have happened there that's pretty significant. They were doing positive net income clear back in 2014 and 2015, and then ever since then pretty consistently down. So obviously not what we want to see, but at the end of the day, it's not horrible. I'm not too worried about it, especially with the price to cash flow where it is in my mind. Now for the balance sheet, guys, on this one, we want to look at total current assets versus total current liabilities. Then we want to look at the outstanding shares. So total current assets, 21.58 billion. Total current liabilities, 13.67 billion. So more than enough cash on hand to pay off all of their debts. They would be just fine if a emergency happened tomorrow. Now, as far as the outstanding shares, you can see here from 2011, 3.7, 3.7, 3.7, 3.6. So they bought a little back in 2014, issued in 2015, issued a lot in 2016, 2017, bought a little bit back in 2018. So pretty consistent, guys. I mean, it does look like over the last couple of years, they have been issuing a little bit, but nothing to be concerned with. I mean, those are such small amounts, less than 1%, 2%, so nothing to be alarmed with. Now, if it was raising 5%, 7%, that's something much more scary, but I like the fact that it's staying consistent. I would really like to see them start buying back shares. That's what we would want to see. And I think with how much cash on hand, they should have enough to do that. So maybe that's something they could do in the future. But pretty nice looking there, guys. Now for the cash flow statement before we jump into the intrinsic value sheet. So for those of you guys that do not know, the way you find free cash flow is cash from operations minus capital expenditures on your cash flow statement. As you guys can see here, really, really strong over the course of the last couple of years. I mean, they went from negative 1.5 billion in 2018 to positive 2.1 billion in 2017. 2016 to 2017, and then a little bit lower in 2018, a little bit lower in 2019, but up from 2018. And then in the last, 2 years, trailing 12 months in 2020, just exploded. Again, I don't know why that happened. That's something you have to look into. But guys, this is huge. So I usually like to do a 5-year average when I do a price to free cash flow. But in this case, since it's so, so low, the last couple of years before that, I think it would make more sense to use 2020 and 2021, which is I used the trailing 12 months in the discounted free cash flow sheet we're going to look at. But if I was doing a price to free cash flow, I would probably use just the trailing 12 months in 2020, maybe add the 2018 and 2019 in there just to kind of get a better idea, of a range. The way that you do that, guys, is you just add it all up, you average it by however many years you add up and you want to use, and then you divide it by that amount of years. So, you add up 4 years, 5 years, you divide it by 5. That gives you a total average over the course of 5 years, then you times it by whatever designated multiple you want for price to free cash flow. So in this case, you would times it by 10, 15, 20, and then see how that number compares to the market cap. That's how you get, your desired market cap when using price to free cash flow. If it's higher, you can then take that higher number, divide it by the outstanding shares and get a price target, for that. Or if it's lower, you can also do that and get what you want to pay for it. So, but as you guys can see in their trailing 12 months, they've done like, $2.6 billion in free cash flow. Very impressive. Let's jump over to the value sheet, guys. So again, this is a simplified version of a discounted free cash flow model. You can get this over there at the Patreon. I've got a couple of them, some of them that are much more complex, but I really like this one for YouTube videos because it's much more simplified. So as you can see, I put in the data, the share price from yesterday, the outstanding shares, most recent revenue, trailing 12 months revenue, trailing 12 months net income, and trailing 12 months free cash flow. Now, this is where I put in some assumptions, guys, and that's what you do with these types of sheets. And I tried to be as conservative as possible. So for the growth rate for the next 5 years, I put 10% on their earnings, which might be a little bit high, but we can change that and mess around with that. But with 5G coming, they very well could, but probably not. I dropped the terminal growth rate from 5% that I typically use down to 3%, which I think is absolutely viable. Now, as far as the net income, I only did negative 9%, which is what they are already doing, but that doesn't affect this. And then I did 12% on their cash flow margin, which is exactly what they're doing right now. So, I think that's fair. And I was coming up with an intrinsic value of around $10.4, so $10.40, sorry. So 71% upside from current levels. Now, if we make some adjustments here to kind of get a better idea, if we drop the growth rate from 10% to 5%, Over the next 5 years, it drops the share price down to $8.50, still about 40% upside from current levels. If we drop the cash flow margin down to 10%, that's when we start getting closer to that $6 level. So these are the assumptions you have to make, guys. Do you think Nokia will start growing faster with all of the things coming up? Do you think they can start boosting their profit margins, getting higher free cash flow, growing revenue, whatever it is? That will kind of give you an idea of where the share price should be. Me personally, I actually think $9 to $10 is the fair value for it, especially with the fact that they just raised their guidance. If they hit that guidance, I think $9 to $10 is very, very doable. Now, as far as my price target for the end of 2021, because the time frame is much shorter than I would like, I actually based my price target off of the data that is coming off of the chart. I like to think that it would be around $8 by the end of 2021, but in the longer term, 3 to 5 years, up there around that $9 to $10 range, and potentially even longer than that, up there around that $12 to $13 range. If everything goes the way it should, they continue to grow revenue and increase their guidance. Now, with that being said, guys, obviously I have no idea. One thing I will mention is the chart is the reason why I am considering, and I'm probably going to buy some shares of this and start a small position. If it wasn't for the chart looking as good as it is, I probably wouldn't do it, because the fundamentals aren't really that strong to where it's compelling enough to take an entry at these levels. Now, if it was down lower at lower prices, I would, but I just wanted to throw that out there. So let's take a look at the chart, and I'll kind of show you what I mean, guys. So this is a daily chart. Again, guys, we did have a straight downtrend from clear back here, in January 2011, straight down. And then we finally found that bottom, which was also a bottom from back here in 2012. And then we made that big momentum shift. It's kind of like an inverse head and shoulders. Now, the daily is not really what I want to look at. It's the weekly, guys. The weekly is looking so hyper bullish. You've got a beautiful bullish Gartley at a perfect level, guys. When you are looking for big harmonics, this is exactly where you want to find them after a huge extended downtrend. When you have a big markdown like this, guys, over the course of years and years and years, these are those deep value perceived areas that you want these structures to form in, because it's an impending reversal. Major reversals occur down at these levels. You got to realize Nokia lost 100% of its value back here in 2012, where it incepted at. And then it started, making moves, and then it pulled back after this big markdown that started in 2014. It pulled back, but didn't make it to the lows that it made in 2012 or inception. That's showing a lot of strength, guys. That's accumulation. More market participants owned the stock right here at COVID crash than they did back here in 2012. You guys want to see what happens when a big Gartley forms over the course of a lot of years? Look at Ford. This is the Ford chart, guys. This is probably the biggest Gartley I've ever seen in my entire life over the course of like 20-something years. But look at how it did something very similar, guys. Had a huge markup, marked down, came back, 90, 100% of its value right here. And then after the markup and mark back down right there at COVID, pulled back and, didn't quite make it down to where it started at. So again, more market participants owned Ford right here during COVID crash than back here in 2009. And then blast off, guys. That's what happens when you get these huge harmonics in the context of a downtrend over the course of years and years and years. On a weekly chart, you get huge markups, guys. That's like a 390% markup from down here. Now, Nokia is showing the exact same thing, but their initial markup was much, much bigger than Ford's. Now, it has already started to move. It is already up there a little bit farther than I would like it, but with that being said, guys, if we look at the chart here, if we look at the context, we just broke a major supply line that was manufactured back in 2014. Guys, this structures over the course of years. Like, it started in 2012. So this is a 20-year-old, a 10-year-old Gartley, essentially. Now, we broke the supply line. We also broke a major critical inflection point from 1995, guys. That is huge. We also broke these highs from back here in 1997 as well. level from here in 2020, a level from here in 2013, some lows in 2011, a very critical level, guys. And now we might run into a little bit of stagnation or a little bit of stall right there at 642, 645, which is that peak, the initial all-time high from 1997 as well. But guys, I think the target is absolutely 150% undeniably $8.66. Which was also, again, these highs and these initial lows from back here in 1998, another low from 2009, another low from 2010, and then it gapped below it. So, the first target, and we already hit it once with that big, massive scam wick back when Wall Street Bets got a hold of it. So why couldn't we do it again? Guys, this big momentum shift at the PCZ of a Gartley with the inverse head and shoulders, the hidden bullish divergence coming on the way out, impending continuation. This is everything you want to see. This is one of the nicest Gartleys I've seen in a long time, guys. And this is the only thing I'm looking at because the daily is not that impressive. The weekly is really what shows all of the upside. Now, you absolutely, after 866, will probably see 1160. That's your next level. There's nothing really in between it. You may get, held up at 1056, 1078, but guys, I think 866 and then after that, 1160 eventually, and 1056 or whatever that was, after that. Once those are hit, who knows where it could go? It could go much further. It could crash back down to the lower levels. But I think as of right now, those are your targets that make sense. I would really like to see it back test, break the 642, back test it before running again. But it's going to take some serious time, guys. A structure that takes 10 years doesn't manifest over a week. Period. It's going to take time. So I have no problem buying it at these levels. Now you are kind of right in the middle of a little bit of a range. I would like to see it. It is holding this high right here from, which was a candle high close from 2019 and a couple other levels. So if it can maintain these levels, guys, and show some more forward momentum, I will probably buy it and just add to it dollar cost average whenever it hits lower points, because with how everything is looking with the the raising of the guidance, the full year 2021, but then also the 5G, I think there is a lot of upside here, guys. The other thing is if Wall Street Bets gets a hold of it again and it squeezes, they could send it to much, much higher levels. So you've kind of got two things going for you. Now, obviously, we don't want to just play off of the apes, but I think the free cash flow justifies it. The chart justifies it, and I have no problem buying it right here. Again, I will just dollar cost average, if it falls further. So this isn't one that you can jump in and expect to hit the targets in a week, 2 weeks, 2 months, 3 months, or even by the end of the year. But I absolutely think if we break out of 642, we will mark up to 866 rather quickly. And I think by the end of 2021, we could absolutely get there, especially if the apes get back a hold of it. So that's it for today, guys. Let me know down in the comments what you think. If you think that I'm nuts or if you think that that's pretty in line, I would love to hear it. This video is for entertainment purposes only. I am not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. Come over and join us at the Patreon if you want to be part of an amazing family. I'll see you in the next one. Peace.